Thank you all for coming out on a miserable rainy day, but you're going to hear about a sunny country and a sunny story from what I've been told and what I've had a chance to read. I'm Doug Redeker. I'm a visiting fellow here at the Peterson Institute, and we're going to hear this morning from Fernando Casado, who is the managing director of SEC, and he will give you a little background on what that institution is. I was given a brief on it this morning. I think he can fill you in a little bit more thoroughly. And then our own senior fellow, Angel Ubide, who is going to work with Fernando in telling the story. We're going to have a slide presentation, following which we'll all sit up here on the dais and we'll have time for Q&A. So thank you again for all coming out on this miserable rainy day, and I'm going to turn the podium over to Fernando.
Okay, good morning, ladies and gentlemen. Thank you very much to being here and attending this presentation. I am here on behalf of the current president of the Council Competitive Business, Mr. César Alierta, who is the CEO of a Telefónica company. He regrets not being here today, but he thanks to you to attending this meeting. I should like to speak some words about the Consejo Empresarial para la Competitividad, Business Competitivity Council. This council was born in February 2011, so we are quite young, about only 2 years old. But this project was forged at the Spanish Family Business Institute 3 years ago. And at that time, I was general manager of that institution. Probably this is the reason why I am general manager now in the council from the beginning. The members of this council are only 15 presidents of the largest company or CEOs in Spain, together with the Spanish Family Business Institute that he also has represented by 3 presidents of the largest companies of family business in Spain. You have the logos in the invitation, and in the paper you have also the names in the back of the cover. One of the characteristics of the council is that you hold a meeting every month to which only the presidents or CEOs, depends who is the representative in the council, can attend. And if someone misses the meeting, he cannot be represented by anyone else. It's one way of maintaining the highest levels of representativeness within this institution. No? And we are 19 people, few people, and I say it's not easy. It's not very easy to manage this kind of people, but we do it. No? The commitment of all ones is very strong, and then we can do it. The companies joining the council employ 1.7 million direct people in Spain. The community revenue accounts about 35% of the GDP of Spain, Spanish GDP, and the 70% of their sales come from abroad. The council think tanks added value streams primarily from its ability to translate the experience of the large multinational firms that form its membership into proposals oriented to raising the competitiveness of the Spanish economy, as well as international confidence on the country. It's for this that we are here today, guided by values such as commitment, consensus, experience, and global reach. The council has no structure, only my secretary and me, but the members, companies, providers, with the support of departments working to the council. When we prepare documents or proposals, we create specific teamworks with the high-level managers of the member companies. We have works in different subjects as labor, taxation, internationalization, competitiveness, communication, and so on. For example, the work team has prepared Spain, a land of opportunities, has been composed by the CFOs and chief economists of Santander Bank, Telefónica, BBVA Bank, Iberdrola, CaixaBank, President Alerta, and me. We did a draft together, which was sent to the rest of the member companies, And once we get their feedback, we prepare the final document which you have now in your hands. Now, I will explain only the headlines and the conclusions of the paper. Follow me up, Mr. Ubide, who is not formally involved in the council at all, but he will develop with more deepness and content this paper. I thank him that he accepted today to do this presentation. Thanks, Angel. This paper addresses the factors that, in response to the present economic context, stand as proof that Spain is a reliable and solvent country, whose economy will begin to recover during the last quarter of the present year. The Spanish economy will overcome the doubts surrounding the euro breaks up, that's true, but also current doubts about the Spanish economic ability will disappear in order that, as you will see at the end of the Mr. Ubide presentation, Spain is still a very attractive country for investors. Crisis has not affected real flows and perception about the foreign-directed investments. Spain has always been competitive, even more so now. Dramatic external balance adjustment with no currency depreciation. A structural fiscal adjustment in seen until now, gaining credibility. Intense deliberation of private sector, which is now a net saver. Clearly defined fully reform agenda to drive medium-term growth. Cleaned up financial sector and labor market, which is beginning to rebound in specific targets. We expect a gradual recovery during this year, leading to a positive growth rate in last quarter of this year in GDP. The important is that means a change in the trend of the economy. After thank you. Sorry. After 7 or 8 quarters decreasing the GDP, we think that it will start grow, and our provision around 2014 is about growth 0.8 in GDP. And these figures are similar to the one from the international organization, that's International Monetary Fund, OECD, Monetary Union, European Monetary Union, Bank of Spain. And one of the reasons is because the correction factors will lose steam. Export sector will remain buoyant, less severe public deficit cuts during this year, a less pronounced negative impact of housing sector. And we expect that this rebound in economic growth will positively impact employment at the end of 2014. Then we think that in this context, Spain is a very attractive destination for investment because, as you say later, is competitive and innovative. Yes, innovative business generate now 73% of sales and 65% of jobs after construction adjustment. Knowledge-based economy is growing, very favorable climate in which to do business. We have an attractive labor force achieving productivity levels that are growing 2 or 3 times higher than Europe average, and very good stock in infrastructure and strategic location for accessing emerging markets, that's Latin America or as Africa also. Finally, we are convinced that Spain is well positioned as its both sectors with considerable strategic value, which are gaining in relative strength. Buoyant case strategic sector with growth potential, the service sector gaining ground due to the sharp rise in non-tourist services and maintaining the leadership in tourism, and the Spanish multinational with increasing leadership in several sectors. The most of these multinationals are members of the Council. Well, thank you very much for your attention, and now, Mr. Ubide, the floor is yours. Thanks.
Thank you, Fernando. Thank you, Doug, and thank you to the Peterson Institute for hosting this. As it was said before, this is an independent report prepared by the Spanish Corporate Council of Competitiveness. It is independent, and I am independent from them. And the views I'm going to disclose here and comment are essentially the views in the report, and they are not associated with any of the other institutions I am affiliated with. So basically, the story of this report is the following. We all know that the most persistent impact of a crisis is the narrative that people write about it. Because the dynamic of a crisis is very simple, right? You have a crisis, the media writes about it, the international financial institutions tell you what you need to do, and then people forget about it. There is a long process of fixing what needs to be done. There is a long process of reforms, but nobody pays attention to the progress on that. Why? Because it's much more interesting to move to the next crisis. And what has happened in the case of Spain is that there were two issues. The first one was the serious doubts about the future of the euro area. And for those of you who have followed the debate here at the Peterson, you know that you were wrong in doubting the political commitment to keeping the euro area together. But if there are still doubters there, let me tell you that my personal view is that that political commitment is very strong. And therefore, you shouldn't think about Spain in a context of a euro area that is about to break up. You should think about Spain in the context of a monetary union that will be successful down the road. The second story that was told is essentially summarized in those bullet points there. There were very serious doubts about the capacity of the Spanish economy to do what it took. The first point, which was incredibly sticky, was that Spain was not competitive. Everybody saw a chart of real effective exchange rate relative to Germany and saying there is no hope. The second point was that the Spanish debt was high. You look at total debt of the country and it was high compared to many other countries in the developed world. The third point was Spain will never be able to adjust the fiscal deficit. Maybe the central government can do it, but the regions will never do what it takes, and the central government will never be able to keep the regions to do what they need to do. Fourth point was the banking sector is not solvent. Forget it, it's bust. And the fifth point was Spain is not committed with reforms. It's a country with a lot of rigidities. There will be no progress in doing this. Well, this report is about showing to you that all of these points were unfounded, and that now we need to replace that narrative with the process that has been undertaken in all of these areas. Let me start with the first one, which I think is the most important one. Spain was not competitive. That simply was not true, okay? It is quite misleading to look at macro competitive numbers in situations where the real economy shows some sort of duality. And that is a characteristic of Spain that people didn't know. If you look at the chart on the left, you can see that Spain has been the country of the developed world that has lost the least share in market share in the recent years. And this is quite impressive because this happened while those real effective exchange rate charts were showing the divergence in competitiveness. Why is that possible? Well, there are several reasons. One of them is that Spanish export companies are more productive compared to the average Spanish firm than in the rest of the comparator universe. If you look at that, the Spanish medium and large enterprises, which are the ones that are involved in export markets, are around 40% more productive than the average firm. Italy comes close, but in the US, Germany, or France, that difference is quite smaller. And so when a Spanish firm took the suitcase and went abroad, they found that they could compete quite positively versus other countries. If you have to leave this room with one chart, please leave with this chart in mind and replace the chart of the real effective exchange rate divergence with this. This shows the improvement in the current account balance over the last 4 years and the change in unit labor cost. So even if you are not willing to believe my story that the microeconomy is much more productive than the macroeconomy, now you can have a story about the macro. The improvement in the current account, which is on the vertical axis between beginning of 2008 and 2012, has been 8 points of GDP. Now the current account is basically in balance. The primary current account is in surplus. And let's not forget that Spain has a chronic current account deficit in energy of 2 or 3 points of GDP. So the underlying progress has been very strong. If you look at the report that the Commission published this week on the excessive imbalance procedure, you will see that they admit that about 80% of this improvement is structural. So yes, there has been a recession, yes, there has been some decline in imports as a result of the decline in demand, but this is a structural improvement. Part of it, or a big part of it, has been the improvement in unit labor cost. If you look at the change in the horizontal axis between, again, 2008 and 2012, that corresponds to a decline in unit labor cost of around 4%, 4 percentage points, I'm sorry. Why is that? Well, very simple, because there has been a very important slowing down in wage growth. As you know, there has been some labor reform that I'm going to be discussing later as well, but in the last year, wage growth has essentially been zero in nominal terms. So in real terms, there has been an important improvement in competitiveness that if you add to the improvement in productivity, you get this change in unit labor cost. Now, some of the other members of the euro area have not been doing that well. Germany, fortunately, because that's what we want in terms of internal imbalance, internal rebalancing in the euro area. But the Eurozone, France or Italy, have been doing quite worse in that regard. So I think Spain is a positive outlier in terms of the improvement in the external sector. Now, this is just giving you a little bit more of detail. It shows the change in the current account over the last 4 years. You can see that it has been well balanced. It has been improvement in goods and improvement in services. That has been quite important. If you look at the chart on the right, it is quite impressive. That shows the share of exports as percentage of imports. So basically how the economy has been able to change in the composition of internal and external demand. The improvement from April 92 to June 97 was also very good. It was associated to a 35% devaluation of the peseta. So the similar improvement that you see between 2007 and now has been done under a fixed exchange rate. So for all of those who have been writing op-eds saying that internal evaluation is impossible, maybe you want to think about this, and maybe you want to take the example of what other countries have been doing, as Anders has been saying of Latvia and others. It is possible to do it, it has been done. And in fact, after all, it may be the right thing to do. Why has this been possible? Well, there was a very static view of the world, right? Your export portfolio is fixed in terms of products and in terms of countries, and therefore you are stuck. Well, that's wrong. The export portfolio is dynamic. And what the Spanish firms have done is to change the product mix, move it in the value-added scale, and go and open new countries. Look at that. Sales to Africa, Latin America, and Asia, which are the growth countries, the growth areas in the world, are up by significant amounts. And I was given this morning a survey that I'm not sure it has been published yet, but in terms of attitudes and expectations of exports for the next 3 to 12 months are even better than what they show. So essentially, there is external demand, and Spanish firms seem to be very well positioned to take advantage of that. And by the way, we just ran the first ever trade surplus with the Eurozone. So even internally, there has been some rebalancing, and the rebalancing has been possible because of this internal adjustment. The second story was the private sector is highly in debt. That's a problem. Well, it's true. Look at the financing requirements of the private sector to the rest of the world, minus 3.5%. That has changed. It has changed by a massive amount, 18 percentage points. Now it's in surplus. And that surplus has been achieved basically by saving. It has been a very impressive performance of the household sector because, as you know, there has been very little sending the keys in the mail as it has happened in other places. So the amount of defaults in the household sector has been quite small. So the reduction in the leveraging of the household sector has been achieved mostly via savings. In the corporate sector, there has been a fair amount of asset sales, but I think it's important to understand that a lot of the Spanish corporate sector is multinational, so the GDP may not be the right denominator to measure, right? When you measure leverage with respect to assets, is not that big. In fact, it's comparable to what Germany may have, around 40%. Now, there has been improvement. Perhaps the picture was painted a little bit too negative at the beginning by using the wrong denominator, and the process has been positive and continues to move forward. Did I move to? No, okay. Because this screen is touch screen, I was told, and I may be touching too much. The next step is fiscal adjustment. Again, there were many doubts. You probably all remember Spain had a 2% fiscal surplus or close to it in 2007 or 8 before the crisis came. There was a big change in the fiscal accounts due to the impact of the crisis plus some structural measures that were put in place. The final result was a deficit of 9% of GDP in 2011. The view out there was they will never be able to fix that. Well, I think that chart is quite illustrative. There was a 2.5% increase in the deficit due to the operation of the automatic stabilizers, but there was a structural adjustment of close to 5% of GDP. The final number is not going to be 6.7, it's close to 7 due to some accounting fixing and changes that Eurostat is imposing, and the structural adjustment is probably 4.6 or something like that. But again, the number remains. That's a very impressive structural adjustment in the fiscal account. And that has been happening in a context of low growth. In fact, it has been happening in the context of recession, right? And this is something that I think needs to be considered as another positive aspect of all the effort that has been put in place. Reforms. Well, the OECD Going for Growth report argues that Spain is one of the countries most committed to reforms, as we can see on that chart. Maybe you have lost a little bit of the picture during the last couple of years simply because there have been too many things. And maybe by doing so many things, it has been a little bit complicated to convey a message of a strong commitment to reform because there wasn't an obvious focus on one. There were just too many things that were being put in place. But these reforms have touched basically all the sectors that needed to be touched. There has been labor market reform, the regulation of professional services, which is one of the issues that we have in Spain that is probably keeping inflation a little bit higher than it should be. There is progress on restoring the single market for goods and services in Spain. There has been progress on pension reform. There has been extension of retirement age and reduction of replacement ratios. And there are several other reforms that are taking place right now in order to improve potential growth. So, of course, it's not perfect. Of course, there is much more that needs to be done. But there is progress. And again, when there was this view that Spain, be the public sector or the private sector, would never be able to accept this, I think that that view was a little bit wrong. The banking sector has been a sticky issue, right? There have been several waves of restructuring, of recapitalization. There have been changes in the perception of what Spain was doing. At the beginning, a very good assessment of what the Bank of Spain was doing. If you remember the initial stress test in 2010, that changed. There were many more doubts. At the end of the day, if you remember, sometime 12 or 18 months ago, there was this debate that the total recapitalization need of the banking system in Spain would be around 30-40 billion according to the government. Markets were always saying double that, triple that. Well, at the end of the day, it has been that. It has been the total amount of funds that have been deployed is around 6 percentage points of GDP, which is perfectly in line with historical average, with historical experiences, and has taken to a banking sector that right now is reasonably well capitalized, especially the banks that didn't have to undergo restructuring. And what is important is that credit, even if at the macro level is contracting, because it should, because the economy needs to deliver, credit is still being provided to the sectors that deserve it. There is a very interesting process whereby if you look at the micro data on credit, large companies, but also SMEs that are in the sectors that are productive are receiving credit. And we should take that as the process of creative destruction. We don't want to keep zombies around. It is okay if some SMEs don't receive credit and they have to shut down. It's part of the process. It looks scary while it happens. but it's the way it's supposed to happen. Perhaps because markets don't just read the media and they also look at the numbers, FDI flows have continued and changed despite all this negative commentary about Spain, right? Net FDI flows, if you look in the chart in the upper left, have essentially been unchanged with respect to the pre-crisis levels. And surveys and anecdotes from external investors continue to suggest that Spain is a good place to allocate FDI. I will show later in the presentation some of the examples of the work and the things that the Spanish companies are doing. But this is basically what the rest of the world seems to be thinking about Spain. So let's look at the near term and at the near term economic outlook for 1 second. I think the best way to describe the situation is that in 2012, for the first time, the outcome was better than expected. If you take the forecast and the opinion of the consensus and the forecasters in the first half of 2012, there was a very gloomy view. The gloomy view was predicated mostly on the fiscal adjustment that needed to happen and on the lack of hope that the external sector was going to be able to drive the recovery. At the end of the day, 2012 was better than people thought. A key reason, which is mentioned up there, is that the multiplier of the fiscal adjustment was smaller than people thought. And there is an important reason for that. The multiplier of the fiscal adjustment in a recession that is associated to a credit crunch is very strong because there is a cash crunch on the private sector. All of a sudden, the public sector stops spending and stops paying. Why? Because they are suffering a sudden stop. What the Spanish government did was to put in place what is called the supplier payment plan, which was a way of channeling cash, of channeling funds from the public sector to essentially pay the arrears that the private sector was suffering. That was an automatic infusion of money. So if you want to think about what was the impact of OMT, the impact of OMT was that the Spanish public sector was able to borrow again at reasonable rates and be able to channel that money directly into the real economy. You can call that a helicopter drop if you want, but it was quite effective. And that was one key reason why domestic demand was able to hold up better than what one would have expected given the extent of the structural fiscal adjustment. The path of growth, frankly, has not been very different from what you would have expected for a real estate crisis. That's essentially what that chart shows. You know, the blue cloud is the ranges according to history. The blue line is the average of the growth performance of 4 countries, the UK, Denmark, Ireland, and Netherlands, who could have been, in very heterogeneous situations as compared to Spain. The UK is a favorite of mine in making this comparison because the UK had a depreciation of 20-25% of the currency, had their own central bank, and yet they haven't been able to perform better than Spain. Just to illustrate, again, the dynamic behavior of the private sector, if you subtract, and of course you can always subtract all the things that you don't like, but bear with me for 1 minute. If you subtract the sectors that need to adjust in Spain because of the need to have a structural adjustment, which is construction, financial sector, and public sector, the performance of Spain is similar to the Eurozone, which is the way it's supposed to be. In fact, if you only subtract construction, the performance of Spain is even better than the average of the Euro area. So it is, again, another way to illustrate that you sort of have a process of replacing the sectors that need to contract by the sectors that need to take that space, and that takes time. It's the same thing that happens all the time. It has happened in the US, it will happen in Spain, and it will be a successful story eventually. So what's the outlook for the near term? The outlook is uncertain. As we had here at the Peterson Institute recently, we look at the global economic outlook, and David Stockton said that for the first time he thought the risks were balanced, not to the downside. I would venture to say that even the risk could be a bit to the upside given the global environment. The US is picking up, Japan is doing a very expansive monetary policy, asset markets are rallying. The situation in Spain is essentially that the second quarter will still be negative, quite likely given carryovers and the data that we have. But I think there is a fair chance of a stabilization of growth in the third quarter and showing some positive growth in the fourth quarter. The reasons, again, the outlook for export is quite good, not just because of external demand, but also because of the penetration of Spanish firms. Spreads are coming down. If you haven't been looking at your Bloomberg because you don't have access to Bloomberg, Spanish yields are down to the levels of late 2010, which, again, the same way that it was providing a big headwind during the widening of spreads, now is providing some relaxation during the contraction of spreads. And the fiscal adjustment is going to be smaller, right? This year, the fiscal, let me make sure I say the right numbers. Sorry, this sensitivity of this thing is tricky. The fiscal contraction this year is probably going to be no more than 2.5 percentage points, and for next year is around 1, assuming that the current plans are maintained. So this is a situation where some of the headwinds are starting to come down, and that's the reason to believe that there could be a recovery. But the important thing here, forget the second decimal. What matters is the second derivative, right? There has been a recession that has lasted 4 quarters. It could last 5, it could last 6. It doesn't matter. The second derivative is changing. We are hitting the bottom, and it should be a bounce back from there. You could think that that's a chart of the German economy, right? That's exports, and exports eventually will pick up the mood in the domestic economy, and CapEx will follow. Well, that's what has happened. The question is, when is CapEx going to follow those exports? You can trust the line on exports. The question is, what's going to be the timing on the line on machinery and equipment investment? It could take another year, it could take 2 years. The good news is that the corporate sector is a net saver, so they have enough money to fund any expansion in investment. They can even ignore the banking sector. They could fund it with internal funds. The bad news is that normally these things take time. It takes time to build confidence that you can expand capacity again. So in the US, it has taken a couple of years. Maybe now we are starting to see the light, and we are starting to see the corporate sector becoming a little bit more optimistic. Maybe in Spain it will take 1 year, it will take 2, but that's essentially the model that is going to be followed in the next 2 or 3 years, and the model that is going to be used to rebalance the composition of growth. The housing market has obviously been the source of the problem. There were also plenty of doubts that assessments and estimates were accurate and correct. Well, I think we have come a long way. In terms of share of GDP and employment, the contribution of housing and related activities was in the 12-13% of GDP at the peak. It's down to 6. The long-term average is around 10. So there has been some overshooting to the downside. You can see in the upper left side. Eventually it will come back. It's the same thing as in the US. Housing starts have overshot to the downside in a big time. And if you try to buy a house today in DC, it's very difficult, as some of my friends have been telling me in the last few months. So this will happen. Now, the number to remember is this. The amount of oversupply in Spain is around 700,000 houses right now. Household formation is in the 150 to 200,000. Add some foreign demand, which seems to be not just not going away, but it seems to be improving because they are being attracted to the low prices, as you can see in the upper right side. So clearing up the excess stock could take 2 or 3 years in a good scenario. It could take a bit more depending on what happens in the rest of the world. It's not terribly different from what has happened in the US. So there is still a process where housing is going to contribute negatively to growth, and then eventually it will come back. Something important in case you hear anecdotes. The distribution across regions is very uneven. It's exactly the same thing as in the US. So there are some areas in Spain where the amount of excess stock is quite high. But there are many other regions in which the stock is average and is normal, especially in the cities. So there are going to be stories that point both ways. This is the reason why. And it simply makes sense, the same way that Florida had a very different situation from North Dakota, just to put an example. The labor market reform is perhaps too young to have a convincing assessment, but the initial numbers that we are seeing are promising. Perhaps this chart here is the best illustration. For those of you who don't know, the purpose of the labor market reform was to reduce the duality of the Spanish labor market, try to channel more employment creation towards permanent contract and less towards temporary contracts. And that seems to be what is happening. There has been an increase in the job flows that relate to job creation. It has been mostly into permanent contracts, which most of them belong to the new permanent contract that was created during the reform. But it's a good sign. The other important thing was the changes that were made that gave internal flexibility to wage negotiation inside the firm. There has been a very sharp increase in something called ERES, which essentially means playing with the hours margin rather than playing with the body's margin. So if the bulk of the adjustment in the employment sector in Spain was mostly firing people because the cost of firing was very high, now it's shifting towards reducing working hours. And that is good. That's the way it's supposed to be. It's much better for productivity, and it provides flexibility to the economy. Salary levels in the new wage agreement are quite low, basically zero growth in nominal terms. There is a very important detail here for those of you who don't know. There was this clause in the labor legislation in Spain called ultra-activity, which essentially meant if there was a wage agreement, the parties could not come to a new agreement. That agreement would be extended forever. Now that has been changed. If there is no new agreement within 2 years, the agreement evaporates. And that is creating important changes in the way wage negotiations are taking place in Spain now, because now the unions have less bargaining power, if you want, at the time of demanding high wage increases when the demand is not there. So that's the economic outlook. Let me conclude with a few examples of what the Spanish firms are doing at the micro level, and then we'll end with what needs to be done at the reform level. So this is just going to be anecdotes that you may or may not know, but there is plenty of activity in Spain in sectors with knowledge and innovation. We have 4 of the top 20 business schools in the world. I learned yesterday we have 3 of the top 10 law firms in Europe, assuming that that's a positive thing to have. There is a fair amount of action in scientific areas. We have a very high share of workers with a university degree, higher than the EU average. So it is a country that, despite the appearances, it has an important degree of knowledge. Now, this is another chart that I think is important to remember. Why, again, are Spanish companies productive out there and competitive? Well, because the level of compensation is lower, right? If you look at that chart, the average compensation per employee in Germany, France, and Italy is 43,000 euros. In Spain, it's 34. Now, it may not be a surprise that most of the European car manufacturing companies are moving production back to Spain. It has happened with Renault, it has happened with Citroën, it's happening with Opel. They are moving production to their factories in Spain because they are cheaper and more productive than the others they have in Europe. This is something that, again, there was a big process of catching up during the 10 years of the euro, and that's what looked scary in terms of the deterioration of competitiveness. But once you look at levels are still competitive. There is, again, the duality of the Spanish corporate sector. The firms that operate in sectors that here are defined as sectors with potential, biotech, aerospace, food, machinery, tooling, they are simply more productive and they grow more. It's a question of making that sector bigger. That sector is growing in terms of products, it's growing in terms of number of firms, but it is moving, again, in the right direction. And it's becoming leader in many areas. Let me tell you an anecdote which relates to food, in fact, 2 of them. The first one is that I learned that there are over 1,000 wineries in Spain that export to the US. That's a lot. To me, it was a very, very big number. But there is another one that is even more interesting. There is a move to sell turkeys in the US with a Spanish denomination of origin. So there is several actions that are taking place in the market of food and agricultural exports that is making of Spain close to a market leader. The same thing is happening in biotechnology. There is a lot of startups that I learned yesterday in Boston that are operating in this area and in the sector of health and medicine. There is a couple of companies that are advising the government in Massachusetts, trying to sell them software about how to improve the management of medical cost and lower the cost. The services sector has been quite impressive, and this is one thing that I didn't expect, at least myself, but obviously we are leaders in infrastructure. And the provision of construction services is quite strong, especially in the emerging markets. Spanish firms are involved in the high-speed trains in the Middle East, in China, and hopefully one day in the East Coast in the US, maybe. But it is a sector that is developing quite fast and quite successfully. And the same thing with tourists, right? This is the one that perhaps doesn't need much promotion. Spain has always been a tourist destination. The important thing is that it's moving up in the value-added scale. The amount of spending per tourist is increasing, and it's not a positive thing to say, but the development of the Arab Spring is casting Spain in a much better light in terms of competition for tourism in the Mediterranean. Let me just finish here, because I'm probably going too long with the final word on what needs to be done. So this is not all rosy. This was about to tell you that a lot of stuff has been done, but there is much more that needs to be done, right? The public administration needs to be reformed. It would be quite important if there is some spending review at some point that cleans up all the fat that has been accumulated over 16 years of uninterrupted growth. There has to be more progress in labor market reform. It was a good step in the right direction, but much more needs to be done to close the duality of the labor market. And there needs to be much more progress in boosting the productivity of the country, especially education reform. Education reform is one area where Spain has been doing things, not necessarily always in the right direction, but it can be done. And the final point, promoting policies that increase the average size of Spanish companies. That is something that is a bit endogenous. Spain was focused on domestic demand, and therefore you don't need big firms to compete in domestic markets. The more we compete in external markets, the more we need bigger firms. And there are initiatives that are being channeled to that regard. And with this, I thank you very much for your attention, and we can have a conversation. Thank you.